what backwardation would be is New York spot silver, meaning October silver would be this month, would be more expensive than, let's say, December future silver. That we're not seeing yet, but we will see that. And when we see it, we'll know that silver is really in backwardation, and then things could get pretty spirally. Going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections.
Rafi Farber, a well-known financial analyst and commentator on precious metals, recently discussed the concept of backwardation in the silver market, a signal that could reshape how investors view both silver and the broader economy. In simple terms, backwardation happens when the spot price of silver, meaning the price for immediate delivery, becomes higher than futures prices set for later months. For example, if October silver trades above December silver, it's a sign that physical demand is outstripping future supply. According to Farber, this phenomenon hasn't fully appeared yet, but when it does, it could trigger major market ripples. He explains that once silver enters true backwardation, it will reveal a deep strain in the paper versus physical silver markets. Essentially, investors and industrial buyers will be scrambling for immediate access to real silver rather than waiting for future contracts. When that shift happens, prices could spiral sharply upward. However, Farber also warns that such a move could precede a temporary correction before the Federal Reserve steps in to reinflate the system once again. For those tracking precious metals, this could mark the beginning of a critical new phase in the monetary cycle. If you found this insight helpful, don't forget to like, subscribe, and share your thoughts in the comments below.
We've seen the staggering amounts of silver in New York vaults. It's still above 500 million ounces, which until 4 or 5 weeks ago or whatever it was an all-time record. There is silver. There's a lot of it. Even London has a lot of silver. It's just most of it is being stored in ETFs, and in New York, most of it's being stored by who knows who owes this stuff. It's there. It exists. It's just people aren't selling it for the $50 that the exchanges say that it's worth now. So what does the price have to go up to in order for this silver to be dispersed, to the masses or to whoever wants it? Prices are going to have to go up. Gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to. Whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and the defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did, and it reached a low of 1450, and the miners got clobbered, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. Gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then the silver dollar was worth more than the gold dollar. So it was 1918 was the first time this century. You had it in 1968, 1980, 2011. Every single time there's some sort of a monetary reset, minor or major, then silver always handily outperforms gold. Like, obviously, what's that word? Not sporadically. Like in a frenzy. There's just a huge bid for silver, and we didn't see anything near that at all. Like we were applauding, and we were like, giving a nice little polite round of applause to silver when it finally caught up to the rate that gold was rising, and even that wasn't every day. And so maybe since since August or September, silver has very slightly outperformed gold. But so it went from a ratio of like 107 to 1 in April to now 80 to 1 a few days ago. So okay, fine, it's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918. If you want to go into the why, it depends where your vision is most keen, what aspects of the gold and silver market you connect to or you look at, are you able to analyze the best? And I'm always broadly monetary. So whenever silver outperforms gold, it's a signal that credit is breaking down, and either the Fed intervenes and it saves the credit market by adding more credit. Adding more credit means adding more debt, because it's the same thing. Credit and debt are two sides of the same coin. So if the Fed's able to add more credit, add more debt, and then it's like a borrower who you're demanding he pay you back, and then he gets more credit from someone else, and he's able to pay you back in credit, and you're like, okay, fine, so I'll extend the term on your loan, and you'll keep giving me this credit. So that's what the Fed does. It just keeps extending the loan. So as long as it can do that, it can calm down the money markets and expand the credit markets. But when silver outperforms gold, that means either the Fed has to reinflate and suppress the monetary prices in terms of credit, or it's done. And this time they'll try to reinflate and it won't work. It'll be done. And we're just waiting for that last surge of silver over gold. It's going to end somewhere around 15 to 1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to zero, starts QE again, and then the metals just go up. Limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down.
In a deep analysis of the silver and gold markets, financial analyst Rafi Farber outlines why the current positioning of silver could signal a massive structural change ahead. Despite vaults in New York and London holding over 500 million ounces of silver, much of it remains locked away in ETFs and private holdings, unavailable to the open market. The real issue isn't the absence of silver, but the unwillingness of holders to sell at current prices. Farber explains that for this stored silver to reach the market, prices must rise significantly. Until then, the US dollar remains in what he calls a perpetual short squeeze, where there's always more debt than dollars available. This imbalance, once it snaps, could trigger a rush for liquidity similar to past crises. Historically, each monetary reset, from 1918 to 1980 to 2011, saw silver vastly outperform gold as confidence in fiat systems wavered. The next phase, he suggests, may see a similar pattern, with silver surging to a 15 to 1 ratio against gold once the Federal Reserve reinflates in response to a credit breakdown. When that moment comes, the monetary landscape could change dramatically once again. Let's get into the interview.
What changes is the vaults in London. So it's just signaling that London, which is the main physical spot market for the world, is short on silver. Not they're selling it short. I was saying they don't have enough supply, and you can see that in the float, because they have to store for the ETFs. And though ETF storage is not anywhere near where it was in 2011, it's slowly building back to that as investment demand is growing. So, silver squeeze was an interesting movement back in February 2021. Now is when it could really succeed, because if people bought, a bunch of silver ETFs, then they could really blow that spread out, because then London would really need the silver to be shipped there immediately. It's just so it could keep the ETFs in line with price. Because what would happen to these ETFs this is my theory, that if SLV, for example, couldn't store or couldn't buy silver because there wasn't enough in London, then how would it be tethered to the silver futures price? It couldn't be tethered, and then you'd have the SLV, because it was lacking shares, just spiraling higher and higher and higher, and then that would create a feedback loop where it would force London to import silver from anywhere it could at any price just to keep SLV under control, and then you'd have this positive feedback loop that I don't know how they would get it back in control. That's what Silver Screws was trying to achieve, and I think it could achieve that now, specifically because of the spread between London and New York. But why I say it's not backwardation is because New York silver is a different good from spot London silver. People could think, well, gold's too expensive. It's like $4,400 an ounce. I mean, there's probably a little bit of a physical premium on it. To get an ounce would probably be $4,400 today, despite the fall. And they might get some silver, but they might also want something that's more value dense just to preserve their wealth. And they don't want gold, and they think the platinum's really cheap because, they think of the 90s and like, okay, well, platinum was much more expensive in the 90s than gold was. That's why like the platinum credit card is considered a higher line of credit than the gold credit card, that's left over from that decade. So in their mind, platinum could be more valuable. And as markets shift from industrial to monetary, industrial demand is demanded by the creators of whatever piece of capital equipment they're producing for industry, right? Or consumer good. But monetary demand is by definition everyone. So even the slim amount of monetary demand would be more than the very specialized industrial demand for platinum. If you have even a tiny percentage of monetary wake up of people looking for a preservation of value and they don't want gold because it's too expensive, then they'll see platinum is cheaper, so want to take that. Maybe they'll go for it. And that could overwhelm the very, very thin platinum market as it's overwhelming the silver market, which is why you're seeing all this disjointing between London and New York. What that means just very broadly in a broad brush strokes is that the monetary demand for silver is starting to wake up. And the silver market it's not structured for that. It's structured for silver as a commodity. And it doesn't have the capacity to satisfy the demands of people that are demanding silver suddenly as money because they're panicking. Which physical silver should I buy so that I can have more dollars 6 months from now than I had before when I sell it back for dollars? That's not where I'm coming from at all. Like, I'm not going to sell, I don't intend to sell any of my silver for dollars. I intend to sell my silver for stuff. In other words, I intend to buy things with the silver because I don't think the dollar is going to work. And so then the question from my perspective is which coins will be taken the most easily in a market where people are actually handing coins to each other because credit is dead. So I'd say probably government coins would be more liquid. Just because they're more recognizable. Whereas if you have a silver ounce that's around from some mint that has a nice, a very pretty picture of something that nobody's ever seen before, it'd probably work. It'd probably be okay because they'd test it and they'd figure it out that it's real and they would sell to you. But I think it would just be easier if you want to get in, out, shake, shock without, people having to, bring their scales or bring their electromagnetic whatever sensors to check that it's real.
In his latest analysis, Rafi Farber explains that the growing disconnect between London and New York silver markets may signal the early stages of a global silver squeeze, one that could finally expose the system's fragility. London, the world's main physical hub, is showing signs of stress as available silver floats shrink, while ETF storage demand quietly builds. If major ETFs like SLV struggle to source physical silver to back their shares, prices could spiral uncontrollably higher, creating a feedback loop of rising demand and falling supply. Farber suggests that this potential shortage is more than just a market imbalance. It's a reflection of a monetary awakening. As confidence in fiat currencies erodes, investors aren't merely chasing profits. They're seeking a real store of value. Interestingly, he also points to platinum as a potential surprise beneficiary, a rare metal with low liquidity but growing appeal among those priced out of gold. Ultimately, this shift marks the beginning of silver's return to its monetary roots, not as a speculative asset, but as real money for a world losing faith in paper promises. If you value deep financial insight like this, don't forget to like, subscribe, and share your thoughts in the comments below.